30-year mortgage rates hitting their lowest level since last October. And that's giving a boost to home builders. D.R. Horton told Brothers Lennar Pulte.
Ever since the pandemic, we have had a red-hot real estate market, but now many are starting to feel a cool down.
Arizona's housing market is on the edge of something even worse than the 2008 crash, and most people don't see it coming. In just the past 12 months, home sales in some cities have collapsed by more than 70%. Prices are being slashed, inventory is piling up, and investors who thought they were sitting on gold mines are quietly rushing for the exits. Here's the part no one is telling you. The real cracks are spreading fastest in places you'd never expect. If you own property in Arizona, or you're even thinking about buying, you cannot afford to miss this. Stay until the end. I'll reveal the 10 cities where the crash is already underway. Number 10, Sierra Vista. This southeastern border town built its entire economy around one massive employer, Fort Huachuca. For decades, that military base provided stability, steady paychecks, reliable housing demand, predictable growth. But here's the kicker. Federal budget cuts are slicing deep into military spending. Base employment has flatlined while housing costs skyrocketed during the pandemic boom. The math doesn't work anymore. Recent data from the Bureau of Labor Statistics shows the area's unemployment rate climbing to 6.8%, nearly double the state average. Young military families who once drove the rental market are getting priced out entirely. Many are choosing to live on base rather than compete for overpriced rentals. The rental market tells the real story. Properties that commanded $1,200 monthly in 2022 are sitting vacant at $900 today. Landlords are slashing rents, but tenants still aren't biting. Why? Because even reduced rents eat up 40% of take-home pay for enlisted personnel. Local real estate agents report the median days on market has tripled since last year. Homes that used to sell in 30 days are sitting for 4 months. Price reductions have become routine, with sellers cutting asking prices multiple times. But here's what's really terrifying. This isn't a dramatic crash. It's a slow bleed. Transaction volume has collapsed 70% year over year. The market isn't falling off a cliff, it's suffocating. Properties become unsellable. Equity evaporates. Homeowners get trapped. Investment properties are getting hammered worse. Landlords who bought expecting military housing allowance increases are watching returns disappear. Many are quietly listing their rentals for sale, flooding an already saturated market. Sierra Vista represents the danger of single employer dependency. When that employer struggles, everything crumbles. Number 9, Prescott. This mountain town marketed itself as California's affordable alternative. Retirees flooded in with cash from million-dollar home sales. The strategy worked brilliantly until it didn't. The demographic shift is brutal. Baby boomers who drove Prescott's boom are aging out of home buying entirely. Many are downsizing or moving to assisted living. The buyer pipeline that sustained this market for decades just vanished. Mortgage Bankers Association data shows loan applications for homes over $600,000. Prescott's sweet spot have plummeted 68%. Retirees who once paid cash are now watching their portfolios shrink. Stock market volatility makes them hesitant to liquidate investments for real estate. Here's the brutal reality. Prescott's median home price hit $750,000 last year. But the median retiree income in the area, $58,000 annually. The disconnect is staggering. Even retirees with substantial assets are balking at these valuations. The luxury segment is imploding fastest. Homes priced above $800,000 are sitting for 6 months or longer. Sellers are slashing prices $20,000, $30,000, even $40,000. Multiple reductions on the same listing have become common. Short-term rental investments are getting crushed. Prescott attracted investors expecting steady vacation rental income. But bookings have collapsed as travelers choose cheaper alternatives. Operating costs keep climbing while revenue plummets. Many Airbnb owners are converting back to long-term rentals or simply selling. The construction industry that boomed during the pandemic is now contracting. Building permits fell 47% year over year. Contractors are laying off workers. The ripple effects spread through the entire local economy. Prescott's fundamental problem? It built an economy around demographic trends that reversed. Baby boomers aren't moving like they used to. Younger buyers can't afford the market. The result is a demographic void that's crushing demand. Number 8, Casa Grande. The city between Phoenix and Tucson bet everything on becoming a manufacturing hub. Lucid Motors, logistics centers, industrial development, The Economic Development Board sold a vision of explosive job growth. Speculators bought that vision wholesale. Out-of-state investors scooped up pre-construction homes expecting worker influx. Developers fast-tracked massive subdivisions. The city approved permits at record pace, anticipating thousands of new residents. Then reality hit like a freight train. Lucid Motors' production targets collapsed. The electric vehicle manufacturer that promised 3,000 jobs delivered fewer than 800. Other promised developments stalled or canceled entirely. Securities and Exchange Commission filings show Lucid burning cash at unsustainable rates. Recent layoffs hit the Casa Grande facility hard. Workers who bought homes expecting stable employment are now job hunting. The employment foundation that justified the housing boom crumbled. Current housing data is devastating. Inventory has exploded 200% year over year. New construction homes sit empty while builders slash prices repeatedly. Some properties have been reduced 4 times in 6 months. The resale market is imploding. Homeowners who bought pre-construction at peak prices are underwater by $50,000 or more. Many are walking away from deposits rather than closing on overvalued properties. Rental properties are bleeding cash. Investors expected young professionals to fill apartments and single-family rentals. Instead, they're advertising months of free rent and still struggling to find tenants. Occupancy rates have fallen below 70% in newer complexes. Casa Grande's mistake was believing corporate press releases instead of demanding binding commitments. The city infrastructure for 20,000 new residents, but the jobs never came. Now taxpayers are stuck with overcapacity and debt while the housing market collapses. Number 7. Kingman. It became an unexpected pandemic darling when investors discovered homes under $200,000. The affordability story attracted buyers from Phoenix and Las Vegas looking for cheap rental properties. That affordability advantage has completely evaporated. Median home prices that sat at $180,000 in 2021 hit $320,000 by early 2023. The very feature that made Kingman attractive, cheap housing, disappeared almost overnight. National Association of Realtors data shows Kingman posting the steepest year-over-year median price decline in the region. Prices have fallen 18% in just 8 months. Properties selling for $300,000 last year are struggling to find buyers at $250,000 today. The investor exodus is brutal. Landlords who expected easy rental income discovered harsh realities. Tenant quality is poor. Collection rates are terrible. Property management costs eat into profits. Many out-of-state investors have never even visited their properties. Population growth has stalled completely. Census estimates show net migration turned negative last quarter. Young people leave for better opportunities in Phoenix or Las Vegas. Retirees on fixed incomes can't afford the inflated prices. The demographic that drove demand has disappeared. Foreclosure activity is rising sharply. Properties bought by leveraged investors are going back to banks. Some neighborhoods show multiple foreclosure signs on the same street. The foreclosure pipeline will dump additional inventory into an already oversaturated market. Distance becomes a liability in higher interest rate environments. Commuting to Las Vegas or Phoenix for work made sense when gas was cheap and housing was affordable. Now both costs have exploded, making Kingman feel isolated and expensive. The town's infrastructure can't handle the boom-bust cycle. Services expanded for projected growth that isn't materializing. Budget shortfalls are forcing service cuts just when distressed homeowners need help most. This isn't guesswork. We dug into labor stats, housing filings, and market data to uncover what's really happening. And the truth is, the cities ahead are in even bigger trouble than the ones we've covered so far. Subscribe to stay ahead. Number 6. Queen Creek. Southeast Phoenix suburb was transformed from rural farmland to suburban showcase in record time by this town. Developers marketed it as the perfect family destination with top-rated schools and modern amenities. The construction boom was staggering. Builders launched dozens of subdivisions simultaneously. Wide roads, manicured landscapes, community centers. Queen Creek looked like suburban perfection. Families from across the country bought into the vision. But here's the devastating truth. The entire market was built on speculation, not organic demand. Population growth was driven by cheap money and pandemic migration trends that have completely reversed. Now the foundation is cracking. Maricopa County assessor data reveals the scope of oversupply. Queen Creek has more active listings than the past 3 years combined. New construction inventory sits at 18 months of supply, nearly triple healthy levels. Builders are competing with each other and existing homeowners in a price-cutting war. The average days on market has exploded from 14 days last year to 97 days currently. Properties that used to generate bidding wars now sit untouched for months. Price reductions have become standard, with many homes reduced multiple times. The rental market is saturated. Investors who bought multiple properties expecting strong rental demand are struggling to find tenants. Many properties sit vacant or rent below break-even rates. Some investor owners are listing entire portfolios simultaneously. Demographics reveal the deeper problem. Queen Creek attracted young families with children, but those families are increasingly priced out. Median home prices above $500,000 exclude most first-time buyers. The core demographic that drove growth can't afford to participate anymore. Number 5. Flagstaff. This mountain town leveraged its natural beauty and Northern Arizona University to attract pandemic-era buyers seeking cooler temperatures and outdoor recreation. The strategy worked too well. Home prices reached completely unsustainable levels relative to local incomes. The median home price peaked at $650,000 while median household income remained stuck at $52,000 annually. The math never worked for local buyers, only wealthy outsiders. Federal Reserve Bank of Dallas research confirms Flagstaff ranks among the most overvalued housing markets nationally. Price-to-income ratios hit levels not seen since the 2006 bubble. Current corrections are bringing painful but necessary reality checks. The short-term rental market that justified investment purchases is imploding. Airbnb revenue data shows bookings down 37% year over year. Operating costs keep rising while nightly rates fall. Many investor owners are bleeding cash monthly. Local government is tightening short-term rental regulations, reducing investor appeal further. New ordinances limit rental licenses and impose stricter enforcement. Properties bought specifically for Airbnb income are losing their investment thesis. Tourism patterns shifted dramatically post-pandemic. Business travel to Northern Arizona University conferences and meetings hasn't recovered. Leisure travelers are choosing cheaper destinations as inflation pressures household budgets. Hotel occupancy rates remain below pre-pandemic levels. Construction costs in Flagstaff exceed Phoenix levels due to elevation, weather, and logistics challenges. Builders face higher material costs and longer timelines. New construction cannot compete with distressed existing inventory hitting the market. Population growth turned negative last quarter for the first time in decades. Young professionals leave for better opportunities in Phoenix or California. Retirees reconsider relocations as living costs spiral higher. The buyer pipeline that sustained growth has dried up completely. The correction accelerating now will likely overshoot to the downside. Markets that rise fastest often fall hardest. Flagstaff's spectacular run-up sets the stage for an equally spectacular decline. Number 4. Tucson. It's the second largest city built on affordability and stability compared to Phoenix's volatility. That reputation is crumbling as specific neighborhoods face unprecedented challenges. The south and southeast sides of Tucson are experiencing housing market apocalypse. Builders flooded these areas with new construction during the pandemic boom, assuming demand would continue growing indefinitely. They miscalculated catastrophically. Bureau of Labor Statistics employment data shows Tucson's largest employers haven't expanded post-pandemic. University of Arizona, Raytheon, and government agencies maintain steady but flat employment levels. The job growth needed to absorb housing supply increases never materialized. Unemployment in key sectors has actually increased. Retail and hospitality jobs that support housing demand are down 12% from pre-pandemic levels. Service sector wages remain stagnant while housing costs exploded, creating an affordability crisis. Interest rate sensitivity hits Tucson particularly hard because median incomes are lower than Phoenix. Families that qualified for mortgages at 3% rates get priced out completely at 7%. The buyer pool shrunk dramatically as rates climbed. Investment property performance is disastrous. Landlords who assumed Tucson would follow Phoenix's appreciation trajectory are facing harsh realities. Rent growth has stalled while property taxes and insurance costs continue rising. Cash flow turned negative on many recent purchases. Inventory accumulation is accelerating in targeted neighborhoods. South Tucson shows 400% increase in active listings year over year. Days on market extended from 35 days to 120 days. Price reductions occur on 60% of listings. The migration reversal hits Tucson harder than expected. California transplants who drove demand during the pandemic are returning home as remote work policies change. Arizona's tax advantages don't overcome quality of life and employment concerns for many relocators. Number 3, Surprise. This Northwest Phoenix suburb marketed itself as an affordable alternative to Scottsdale and North Phoenix. The value proposition attracted thousands of families seeking new construction at reasonable prices. Geographic location became a liability as economic conditions changed. Surprise sits far from Phoenix employment centers, requiring long commutes that made sense only when gas was cheap and remote work was common. Both assumptions proved temporary. Maricopa County transportation data shows average commute times from Surprise to downtown Phoenix exceed 75 minutes during peak hours. With employers demanding return-to-office policies, these commutes became unsustainable for many residents. The new construction market that defines Surprise is collapsing. Builders launched dozens of subdivisions simultaneously, creating massive oversupply as demand evaporated. Some developments have more homes under construction than sales over the past 18 months. Price competition between builders reached destructive levels. Companies that invested billions in land and development costs are slashing prices to generate cash flow. Some homes have been reduced 6 times since initial listing. The price war benefits no one as margins disappear and buyer confidence erodes. First-time homebuyer programs that drove Surprise's growth are less effective in higher-rate environments. Down payment assistance and mortgage subsidies don't overcome affordability challenges when rates double. The demographic that fueled growth can't participate at current price and rate levels. Infrastructure investments made during the boom now seem excessive. Schools, roads, and utilities built for projected population growth exceed current needs. Taxpayers face higher costs for underutilized infrastructure as growth stalls. The correction in Surprise will likely overshoot as over-leveraged builders and investors liquidate inventory. The community built for continued growth now faces the reality of contraction and consolidation. Number 2, Scottsdale. It built its reputation on exclusivity, world-class amenities, and consistent appreciation that attracted wealthy buyers globally. That reputation is cracking under pressure as market dynamics shift dramatically. The luxury segment above $2 million is experiencing unprecedented distress. Properties that used to sell within weeks now sit on the market for 6 months or longer. Sellers are reducing prices by hundreds of thousands of dollars, sometimes multiple times on the same listing. National Association of Realtors luxury market data shows Scottsdale inventory has nearly doubled year over year. Days on market for high-end properties extended from 45 days to 160 days. The velocity that characterized luxury sales has completely evaporated. Tech sector wealth that drove recent demand is contracting. Stock market volatility and layoffs at major technology companies reduced buyer purchasing power. Executives who drove luxury home sales are postponing purchases or downsizing plans entirely. California buyer exodus that fueled Scottsdale's boom is reversing. Tech workers returning to San Francisco and Los Angeles as companies demand in-person attendance. The geographic arbitrage that made Arizona attractive is disappearing as remote work policies change. International buyers who provided demand stability are retreating. Chinese investment in U.S. real estate dropped significantly due to economic uncertainty and currency concerns. European buyers face strengthening dollar headwinds. The global buyer base that supported ultra-luxury segments is shrinking. The luxury new construction market is frozen. Custom home builders report project cancellations and postponements as buyers reassess spending priorities. Land values that reached astronomical levels during the boom are declining as developers struggle to find buyers for finished lots. Scottsdale's correction matters because luxury markets typically lead broader declines. When wealthy buyers retreat, price pressure cascades down through all segments. The psychological impact of luxury market weakness spreads fear throughout the entire regional market. Number 1, Buckeye. This far west Phoenix suburb transformed from agricultural land to suburban sprawl faster than any community in state history. The speed of that transformation is now driving equally rapid destruction. The scale of overbuilding in Buckeye defies comprehension. Developers converted thousands of acres simultaneously, creating housing supply that assumed permanent migration and population growth. Census data shows population growth has completely stalled while housing inventory continues expanding. Redfin inventory data reveals the catastrophic oversupply situation. Active listings increased over 300% year over year, while sales volume declined 60%. The mathematics of supply and demand have turned completely upside down. There are literally more homes for sale than buyers exist to purchase them. The investor exodus from Buckeye is accelerating panic selling. Out-of-state investors who bought pre-construction properties are walking away from deposits rather than closing on overvalued homes. Some are listing properties before construction completion, creating unprecedented inventory gluts. Builder incentives have reached desperate levels. Companies offer $75,000 in closing costs, free upgrades worth $50,000, and mortgage rate buydowns lasting multiple years. Despite these massive incentives, sales remain virtually non-existent. Price reductions are cascading through all segments. Homes originally priced at $500,000 now list below $400,000. Some properties have been reduced 8 times since initial listing. The psychological impact of continuous price cuts destroys buyer confidence and creates expectations for further declines. Water rights and sustainability concerns create long-term headwinds. Buckeye's rapid expansion strained water resources and raised questions about long-term viability. Environmental regulations may limit future growth even if demand recovers. The foreclosure pipeline in Buckeye is filling rapidly. Properties purchased by leveraged investors and homeowners at peak prices are going back to lenders. The foreclosure wave will dump additional inventory into an already saturated market, driving prices down further. These 10 markets aren't outliers. They're warning signs. What's happening in Buckeye, Scottsdale, and Flagstaff will ripple through Arizona. Buyers should wait for deeper drops, sellers must price aggressively, and investors should steer clear until foreclosures peak. Renters, you're in control. Negotiate hard. The 2025 Arizona housing crash is only beginning. Next comes foreclosures, bank stress, and wider economic fallout. If this helped, hit subscribe and ring the bell. Don't get caught holding the bag. Comment below which market you think falls hardest.